Silver closed Friday at $8,045. I want you to hold that number in your mind, not because it is the important number, because it is the number that is being used right now to convince you the story is over. It is not over. It is at the moment, right before the most important move of this entire cycle. And I am going to prove that to you using data that is sitting in the public record right now that nobody in mainstream financial media is connecting. Because if they connected it, the narrative they have been building all week would collapse in real time. There are 5 data sets that converge this week. Any one of them alone would be significant. All 5 together on the same Friday close have only happened once before in this bull market. And the last time this exact combination formed, silver went up 38% in the following 6 weeks. I'm going to walk you through all 5 carefully with the actual numbers. Stay until the end, because the 5th one is the one the institutions do not want retail traders to understand. And it directly answers whether $80 is a floor or a trap war. Ladies and gentlemen, Growth Grid is here. If this is your first time here, hit subscribe and the notification bell right now. Growth Grid covers the silver market with data that runs ahead of the price, not behind it. If you want to understand what the screen is going to show you before it shows you, this is where you come. Let's get into it. Before I show you where we are going, I need to show you exactly what just happened, because most of the analysis circulating right now is either missing the mechanism or describing it in a way that creates the wrong emotional response. Silver peaked at $90.39 on March 10th. From there, it dropped to $79.35 intraday on Friday, March 13th, before closing at $8,045. That is a $10 move down in 3 sessions. The question that matters is not whether the drop hurt. It obviously hurt. The question is whether the drop was caused by something that changed the fundamental supply and demand picture of silver, or whether it was caused by something mechanical, structural, and temporary, something that was always going to happen at exactly that level, regardless of what silver was worth in physical terms. The answer is mechanical. Completely mechanical. And here is how I can demonstrate that. When silver crashed from its January 29th all-time high of $1,143 down to the low 7s at the start of February, it then staged a recovery. That recovery carried silver from the low to mid-70s all the way back up to $90.39 on March 10th. Now, pay attention to the math here, because this is where the mechanism lives. The move from the February low of approximately $71 back toward the January high of $114 represents a range of approximately $43. The 61.8% retracement of that range lands at approximately $88 to $90. This level is what technical analysts call the golden pocket, the zone where the majority of institutional short positions are pre-positioned because every technical trader in the market is watching the same level and the same probability. Silver touched $90.39 on March 10th. That is not an accident. That is the market executing a textbook mechanism to the cent. What the golden pocket does operationally is this. As silver was recovering from 71 to 90, the narrative on social media and retail channels was building back into bullishness. The dip buyers were confident. The short-term traders were adding. The social sentiment was turning green again. And every one of those retail positions was being placed directly into the zone where institutional short entries had already been loaded. The shorts waited for maximum retail positioning at the golden pocket, the moment when the largest number of buyers were committed, and then they hit the sell button. Every retail long at 90 became a loss at 80. $10 of equity transferred from retail to institutional hands in 72 hours. The key point, and this is the point that the panic selling narrative deliberately obscures, is that nothing about silver's physical supply-demand equation changed between March 10th and March 13th. The same COMEX inventory numbers existed. The same delivery obligations existed. The same Shanghai premium existed. The same global production deficit existed. Only the paper price changed. And the paper price changed because a mechanical technical mechanism executed at a preloaded institutional level, not because silver became less scarce, less demanded, or less critical to every industrial process that depends on it. That distinction matters for everything I'm about to show you next. Because the 5 conditions that are now present after this drop are not conditions of a broken market. They are conditions of a reset market. And resets in a bull market are where the next phase begins. Let me put the COMEX inventory report on screen, because this is the data that the price action on Friday does not show you, and it is the data that tells you what the informed money is actually doing while retail is selling. As of Friday, March 13th, total COMEX silver inventory stood at 341.72 million ounces. That day is the one-year low. The one-year high was 531.87 million ounces. The market has lost 190 million ounces of total inventory in 12 months, a decline of 35.7%. Now here is the internal breakdown that matters. Registered silver, the silver that is legally committed for delivery against futures contracts, stood at 78.95 million ounces. Open interest as of Friday was 115,026 contracts. Each COMEX silver contract represents 5,000 ounces. 115,026 contracts, therefore represents 575.13 million ounces of theoretical silver obligations. Do the arithmetic. 575.13 million ounces of open interest against 78.95 million ounces of registered silver. The registered leverage ratio as of Friday, 7.28 to 1. That means for every single ounce of registered silver that is actually committed for delivery, the COMEX is carrying 7.28 ounces of paper obligations. Compare that to the one-year high of total inventory at 531 million ounces. In 12 months, the COMEX has gone from a state of relative abundance to a leverage ratio of over 7 to 1 on registered metal. That is not a market that is recovering its supply position. That is a market that is tightening its supply position. While paper obligations remain at scale, the 30-day change in total inventory is negative 34.71 million ounces, a 9.22% decline in 30 days alone. At that rate of drawdown, total COMEX inventory reaches levels that have historically preceded forced delivery failures in approximately 4 to 5 months. I'm not saying a delivery failure is coming in 4 months. I am saying the data that would precede a delivery crisis is currently printing in real time on the public record in plain numbers, while the paper price sits at $80. There is a name for the gap between what the paper says and what the vault contains. That name is a supply squeeze, and the COMEX is currently in the early to middle stages of exactly that condition. Not because of speculation or rumor, but because the registered leverage ratio is 7.28, and the total inventory just hit a 12-month low on the same Friday that the paper price dropped 3.93%. The mechanism pushing the price down and the mechanism pushing the physical tightness higher are running simultaneously. One of them is temporary, the other is structural. Every day that passes without new registered inventory entering the system, the structural condition gets worse, while the temporary paper condition gets the headlines. This section is about the macro environment that silver is operating inside right now. Because the price of silver does not exist in a vacuum. It exists in a global financial context, where the largest capital flows on Earth are repricing in real time, and the direction of those repricing flows tells you exactly what the institutional money is doing with its gold and silver positions over the next 3 to 6 months. UK 10-year gilt yields rose nearly 50 basis points in the final 2 weeks of February and first 2 weeks of March. 50 basis points in 14 trading sessions. The UK economy is posting near zero growth. The government's budget projections were built on a falling yield environment. Every additional basis point above the budget assumption blows a larger hole in the fiscal plan. Germany's 10-year bond yield just hit new high territory for this cycle at 2.95%. Germany's manufacturing sector has been contracting for over 18 consecutive months. The combination of a weakening industrial economy and rising government borrowing costs is the textbook definition of stagflation, the condition in which inflation is winning while growth is losing, and central banks are structurally unable to address both simultaneously. If a central bank raises rates to contain inflation, it accelerates the economic contraction. If it cuts rates to support the economy, it accelerates the inflation. There is no clean policy exit. The bond market is pricing the no-exit scenario right now. This is the most important macro environment that exists for precious metals. Not for speculative reasons, for structural reasons. When real interest rates go negative, meaning inflation runs faster than nominal yields, the cost of holding gold and silver drops to zero and then becomes negative. The metal pays you in purchasing power preservation while cash balances deteriorate. The bond market is telling you in 50 basis point increments across two of the world's largest economies that this condition is arriving, not as a possibility, as a priced probability. The cost of government borrowing is rising in economies that cannot sustain higher costs. That combination historically ends in one of two places: monetary accommodation that reinflates asset prices, or fiscal crisis that triggers flight to hard assets. Both outcomes are bullish for silver. One is bullish in a controlled way. The other is bullish in a way that breaks historical price models entirely. The energy dimension compounds this directly. When oil feeds into 45,000 separate products across global supply chains, a sustained oil price shock does not produce a one-time price jump. It produces a rolling wave of cost increases that arrives at the consumer level weeks and months after the initial energy move. Because each step in the production and distribution chain reprices sequentially. The inflation that European bond yields are currently pricing is the forward expectation of that wave arriving, not the wave itself. The wave has not fully hit yet. Silver sits at the intersection of this inflation signal and hard asset demand in a way that no other metal does. It is the only asset class that is simultaneously an inflation hedge, a monetary asset with 5,000 years of monetary history, and an industrial input whose demand curve accelerates when governments respond to energy crisis by pushing renewable energy build-out. All three of those demand vectors are active at the same time. All three are being driven higher by the same underlying conditions that are currently pushing European bond yields to cycle highs. The paper price is at $80. The macro environment is pointing in one direction. That direction is not down. There is currently a $14 gap between the price the Western paper market is quoting for silver and the price the Eastern physical market is paying for silver. Shanghai silver is trading at approximately $94. New York closed Friday at $8,045. That gap is not normal. It is not an artifact of currency conversion or minor regional logistics costs. A 147% spread between the world's two largest silver markets is an operational signal that the price discovery system is fractured, that the mechanism that is supposed to align paper prices with physical reality has broken down. The specific condition making the Shanghai signal more important than the raw premium number is backwardation. The Shanghai futures curve is currently in backwardation, meaning the front-month contract is priced higher than the 3-month and 6-month contracts. Backwardation in a commodity futures market means one thing: buyers are willing to pay a premium to receive the physical metal immediately rather than wait. They're not willing to accept a discount for immediate delivery. They are paying extra for it. Backwardation is the physical market's distress signal. It communicates that near-term supply is critically constrained relative to demand, that the actors who need silver right now cannot wait for the normal futures delivery cycle, and that the arbitrage mechanism that normally keeps spot prices aligned with forward prices has been overwhelmed by physical urgency. The Shanghai Futures Exchange silver inventories are down to approximately 8 million ounces. Compare that figure to the open interest levels. The physical buffer that is supposed to absorb delivery pressure has been largely consumed. Now consider the geography of this condition. Shanghai's premium is not disconnected from New York's price by accident. China's industrial silver demand from solar panel manufacturing, electronics, electric vehicle systems, and industrial chemistry does not pause because the COMEX paper price dropped 3% on a Friday. The physical buyers in Shanghai are paying $94 per ounce because that is what the physical silver market in the world's largest manufacturing economy requires to secure near-term supply. The $14 gap closes. It has to close. Either Shanghai comes down to New York, meaning physical demand in the world as the largest industrial economy gets suddenly and dramatically weaker, which there is currently no evidence of, or New York moves up to Shanghai. The direction of the gap closure is determined by which market is anchored to physical reality and which market is anchored to paper leverage. The registered COMEX leverage ratio is 7.28 to 1. Shanghai is in backwardation with 8 million ounces against industrial demand, running at hundreds of millions of ounces annually. The physical market is anchored. The paper market is the one that needs to move. When the gap closes and the mechanism that closes it is physical delivery demand overwhelming the paper short position. The speed of the move is not determined by the paper traders. It is determined by the physical buyers. Those buyers are currently paying $14 more than the COMEX price and still signing delivery notices. That is not a sign of slowing demand. That is a sign of demand that is indifferent to the paper price because the physical supply equation has become more urgent than the paper price signal. Everything I have shown you in the previous 4 sections is structural. It is the condition of the market. It tells you the direction. What this section addresses is the timing mechanism, the catalyst that converts the structural condition into price movement. The Federal Reserve meets on Tuesday, March 17th. This is the critical event of the next 72 hours. The dollar index broke above 100 in the final 2 weeks before Friday's close, 4 points in approximately 2 weeks. A massive move for the world as reserve currency over that time frame. And every asset priced in dollars, gold, silver, oil, copper, agricultural commodities, got repriced lower when the denominator strengthened that quickly. But here is what the dollar chart's own history tells you about where the DXY is right now. 100 is the ceiling. Every time the dollar index reached 100 or above in the past 12 months, it reversed. January, April, and now March. 3 approaches to 100, 3 reversals. The level at which the strong dollar begins generating consequences that force a policy response keeps producing selling pressure at the same number. The reason the ceiling keeps holding is structural. A dollar above 100 makes U.S. exports globally uncompetitive. It tightens financial conditions in every emerging market that carries dollar-denominated debt. It reduces the earnings of every U.S. multinational that converts foreign revenue back into dollars. It applies contractionary pressure to an economy that is already posting near zero quarterly growth while facing cost-push inflation from energy. A sustained dollar above 100 is economically self-destructive for the United States, and the Federal Reserve is aware of that dynamic. When the Fed meets Tuesday, there are 2 pathways. The first pathway, the Fed signals concern about growth slowing from energy-driven inflation, acknowledges the stagflationary pressure in the data, or reopens any conversation about accommodation. Under this pathway, the dollar reverses from 100. Silver, which dropped from $90 to $80 in direct response to the dollar's move from 96 to 100, stages a proportional recovery. The mechanical force that pushed it down reverses direction. The second pathway, the Fed makes no accommodation signal. Dollar pushes through 100, carries to 102 or 103. Under this scenario, silver faces additional technical pressure and could test the mid to low 70s. I'm not dismissing this possibility. It is a real outcome that requires a real preparation plan. What separates these 2 pathways is the Fed's read on the economy versus inflation. The Q4 GDP number already came in at 0.7%. Consumer sentiment has fallen to 55.5. One-year inflation expectations have risen again. That combination, weak growth, rising inflation expectations, slowing consumer confidence, is precisely the stagflationary data profile that has historically pushed the Fed toward accommodation, even when headline inflation is elevated. The bond market has already priced the probability of a March rate cut at under 5%. Nobody's expecting a cut. What the market is watching for is language. Any signal that the Fed sees growth risk as the primary concern, rather than inflation as the primary concern. A single phrase in Tuesday's statement can move the dollar 2 points in 60 minutes. 2 points on the dollar at 100 means silver potentially recovers $4 to $6 in the same session. And here is the critical context that ties the timing mechanism to everything I showed you in the previous sections. The COMEX open interest is sitting at 20-year lows. Volume has been negligible for multiple sessions. The speculative longs that were wiped out in the drop from 90 to 80 are gone. They are not in the market. They are not sitting at $80 nursing losses. They were stopped out, margined out, and eliminated. What that means for the Fed-driven reversal scenario is this. When the catalyst arrives and the dollar turns, there are no leverage longs sitting above the current price, waiting to sell their break-even. The path above 80 has been cleared by the same mechanism that pushed the price down. The short covering that follows a dollar reversal at 100 enters a market where speculative supply above the current price has been removed, and where physical delivery demand at below market prices accelerates because the $14 Shanghai premium makes every delivery contract taken at COMEX prices a structural arbitrage. That is the setup. Not sentiment, not social media, not hope. The mechanics of a cleared market with physical demand underneath it and a timing catalyst arriving in 72 hours. Let me bring all 5 sections together, because what I want you to leave this video with is not a trade. It is a framework that allows you to evaluate every subsequent price move without panic and without confusion. Today is Sunday, March 15th, 2026. Silver last closed at $8,045. Gold last closed at $517.70. The gold-silver ratio at those prices is 62.3 to 1. At the January 29th all-time high in silver of $1,143, the gold-silver ratio compressed to approximately 47 to 1. A return to a 55 to 1 ratio with gold at $5,000 implies silver at $91. A return to a 50 to 1 ratio with gold at $5,000 implies silver at $100. A return to the January 29th ratio low of 47 to 1 with gold at $5,000 implies silver at $16. None of those numbers require a new all-time high in silver. They require only that the ratio reverts toward where it was 6 weeks ago, toward a level the market already produced once this cycle, under conditions that were less structurally supportive than today. Today's conditions: COMEX registered leverage at 7.28, 28 to 1 total inventory at a 12-month low. Shanghai and backwardation with a 17% premium. European bond yields signaling accelerating stagflation. The dollar at its historical ceiling. Open interest at 20-year lows with the speculative longs completely washed out. And a Federal Reserve meeting in 72 hours that carries the potential to remove the mechanical force that produced the $10 drop. All 5 conditions simultaneously. Not 2 or 3, but all 5. That combination has one historical analog in this bull market cycle. The last time 5 of these conditions aligned, silver did not slowly recover. It moved. What this data does not tell you is the exact day it moves. That is the honest answer, and I will not pretend otherwise. The dollar could push through 100. The Fed could be more hawkish than expected. Silver could test the low 70s. I have shown you the structural case. I have also shown you the risk scenario. Both are real. What the data does tell you definitively, numerically, without interpretation, is that the physical market for silver is tighter right now than the paper price represents. 7.28 registered ounces for every paper obligation. $14 of Shanghai premium. 6 weeks of vault drain bring total inventory to its lowest level in a year. Those are not opinions. Those are the numbers in the official records. When the paper price and the physical reality diverge by this magnitude, the resolution is always the same. The paper moves toward the physical. The question is, which catalyst starts the process? And that question gets its first answer on Tuesday. Watch the dollar. Watch the Fed language. Watch the COMEX registered inventory update. Watch whether the Shanghai premium widens or narrows. Those 4 data points will tell you more about silver's next 30 days than any price chart alone. If this breakdown gave you clarity that the other coverage this week did not, hit the like button right now. Subscribe if you're not already here. Share this video with one person in your circle who watched silver drop from 90 to 80 this week and has not yet understood whether that drop is a warning or a setup. The data does not lie. The paper price is temporary. The vault is the permanent record. Today is Sunday, March 15th, 2026. Silver is at $8,045. Now the clock to Tuesday has started. Growth grid here.